Well, thanks for joining us. I'm Marlon Bowling, your tour guide to the ag commodities, and we're going to take a look at the markets from the perspective of Mr. Brian Hoops, the president of Midwest Market Solutions. And Brian, a little choppy market action this morning, but this time we're reversing to the upside in the corn market here. And we had the planting progress numbers that came out from USDA yesterday. I wanted to run through a few here. First of all, we can take a look at the national planting progress and kind of recap what we had here last week. Not a big surprise. Corn, 4% planted. The average is 3. Cotton, 8% planted. The average pace would be 7, so pretty close. Grain sorghum, 14% planted. Their average is 17, so actually a little bit behind schedule on the milo planting. Now, the rice planting is also behind by 5 points. We're at 23% planted now. The average is 28%. But the spring wheat planting actually ahead of schedule at 11% done, and the 5-year average is 6%. I would imagine that, Brian, that probably is related to the fact that it's just been so dry in the northern plains. There wasn't much to hold the folks out of the field.
Yeah, right, Marlon. Good morning. It's been very dry in the northern plains. In the rest of the Midwest, it's been extremely cold, and so farmers may be a little hesitant to put a corn seed kernel in the ground in fear that it won't germinate properly. And the market is also reacting to this by anticipating, or fearing anyway, that if farmers don't plant right away, if they don't get the crop in the ground, is that going to push the planting dates back? Are we going to have yield losses because we go into the summer and the crop will be pollinating under the hottest conditions of the summer? It's way early to really be thinking about that as a possibility, but the market's always trading this fear before the fact. We're trading fear right now with December corn moving higher here. This is the possibly the highest close that we'll have in the contract life if we can hold these gains where we're at today. We've been closing around 494 and a half or so, right in that range the last 3-4 days. But a close over $5 will indicate to us anyway that this market is telling producers we need to get the crop in the ground, we need to get more acres seeded, and it's doing that with higher prices. Of course, tighter basis levels are a supporting feature as well, but market is going to be very sensitive, I think, this entire growing season to the growing conditions, and so far, we're just normal as far as our planting pace, but we could start to fall a little bit behind if we get cool conditions that don't warm up.
Brian, there's always a debate. It goes on every year. And what if we have a hiccup in production of U.S. corn this year? We'll use corn as an example. But let's say we get into maybe May or June or something, and weather conditions don't really look all that great for corn production. Would that benefit the nearby contracts more, or would it benefit the new crop December contract more, even though it's quite a ways out there?
Well, the answer is yes. If we get into a hiccup this year, it's going to affect all the contracts. It's going to be bullish, not only on old crop, but new crop. It's going to be affecting the next year's crop, the 22 year. It'll spill out to the 23 year. There's going to be this incentive for the markets to encourage farmers to plant next year. If we do have some sort of a hiccup or a shortfall this year, we have to make up for it as a subsequent year. So all these all the contracts will be affected rather positively. Right now, if you plug in balance sheets and you use a trendline yield about 6 bushels higher than what we grew last year, you're looking at ending stocks being relatively unchanged from the last year's crop. We really don't improve things, and that is a concern, because if we do have that hiccup where, like last year, we don't grow quite as good a crop, we're going to tighten up balance sheets even further, and prices could get kind of explosive this summer. So we've had clients talk with us about if they're making cash sales now, do they look at reowning it? And I think once you get to that more than a third of the crop sold, you really have to start looking at some ownership strategies to protect yourself in case things do go crazy this summer. It's a long growing season.
All right, let's review with our quotes provided by Bar Chart. On the corn market right now, we are still trading higher. May up 11 1/4 at 580 1/4. December up 6. In the soybean trade right now, you have the May contract 8 3/4 higher at 13.90 3/4, and you have November gaining 6 cents. We're at 12.56 1/4. In the wheat trade in Chicago, we have July a nickel higher at 6.36 1/4 this morning. In Kansas City, you have July now trading 6 1/4 higher. We're at $5.93 per bushel. And in Minneapolis, we have the July 4 higher at $6.54 1/4. We'll come back and we'll take a look at livestock trade with Brian right after this. I did want to take a look at our energy markets here, and on the West Texas Intermediate crude, we currently have the market a little bit higher. The May contract 44 cents higher. We're at 60.14 per barrel, and a lot of folks keeping tabs on the Dow Jones Industrial Average now 110 points lower at 33,521 right now. Well, does that have any impact whatsoever on our livestock trade? You be the judge. You have June live cattle now 30 cents lower at 121.80 per hundred, at a high of 122.32. So there you go. We're off of that by about $0.50. August down 50 cents at 121.45. On the feeder cattle market, it's been a bit of an adventure here today. We have the May contract had a high early on of 149.80, and now we are at 148.65. So we're about $1.15 off of that. We are down $1.05. So that means at one point we were about a dime higher, but now we're down $1.05. And we have everything from May on out over $1 lower right now, but it's off its earlier lows by about $1. Does that all make sense? Yeah, we're kind of in the middle of our trading range right now. Lean hogs, as we go over here, we currently have the May contract 47 cents higher now at 104.87. They sold that thing off quite a bit earlier. Got as low as 103.20. Now we're back up by about $1.50 off of that. June now at 106.27 as it rebounds. Now we're 12 cents higher again. And we're back within about 30 cents of our high of the day. Let's go back to Brian Hoops and try and make sense out of all this. First of all, on the live cattle market, we're mixed to a little weaker today. But I really don't see any cash cattle trade kind of early in the week. It looks like asking prices, they keep getting a little bolder every week. We're talking, what, 125 this week?
Yeah, I think that's right. We could see cash trade develop a little bit later in the week. Packers have a lot of margins to work with in here, so I think they're going to keep these kill speeds pretty aggressive and keep things moving. They want to take advantage of these profitable margins that they have. So that demand for cattle, I think, will be there this week. We've maybe seen a little bit of a top in the boxes, and if that's the case, this could be a very strong week for cash trade and start to falter after that. But you know, the market has been down for about 3 days in a row now. Should find some support and try and bounce if this is still a strong market. So hopefully we can see higher prices later this week in the cash markets, and futures will rebound as well.
Beef cutouts were mixed on the last update. We will get some new updated numbers at 11 o'clock Central Time. That means they'll be out in about 35 minutes from right now. Brian, thanks for the time. Always good to visit with you. Brian Hoops of Midwest Market Solutions in Springfield, Missouri. Tammy, I'll turn it back to you.